Welcome to French Tax Online. I frequently, or should I say always, talk about real estate investments on my channel and website, and today we're keeping that tradition alive by diving into the calculation of capital gains in a company subject to corporate tax, impôt sur les sociétés in French. Indeed, I often scare you with the complexities of this type of ownership, so I've decided to break it down and explain in detail what kind of fiscal sauce you might be facing in this situation. Buckle up, this is going to be another fascinating video. Let's get started. Corporate tax companies, definition and explanation. A corporate tax company is a legal entity separate from its shareholders. Unlike companies subject to income tax, IR in French, such as SCLIR or SRL de famille, a corporate tax company is directly taxed on its profit. Consequently, shareholders are not personally taxed on the company's profit unless dividends are distributed. In the context of a real estate investment, the most commonly used structure are the corporate tax SCI, SAS, or the SRL. These companies often opt for the corporate tax regime due to its tax advantages, especially when reinvesting profits back into the business, thereby avoiding direct taxation of the shareholders. Corporate tax in France is calculated on the company's net profit, meaning the net income after deducting expenses and depreciation. The standard corporate tax rate is set at 25% with a reduced rate of 15% for the first 42,000 euros of profit. Not too bad. Differences in calculating capital gains between an individual and a corporate tax company. The calculation of capital gains on real estate for an individual fundamentally differs from that for a city company. Capital gains for individuals are calculated as the difference between the sale price and the purchase price of the property increased by certain costs and reduced by allowances for holding periods from 5 years of ownership. This is leading to total exemption after 22 years for income tax and 30 years for social charges. The resulting capital gain is subject to income tax at a rate of 19% and social charges at a rate of 17.2% or 7.5% in some cases. We made different videos on these topics if you'd like to know more. For a corporate tax company, in this case, the capital gain on real estate is calculated differently. First, the property is recorded as an asset of the company. Its value can be depreciated over many years, which helps reduce the taxable profit each year. Upon the sale of the property, the capital gain is determined as the difference between the sale price and the net book value of the property. That is to say, the purchase price minus accumulated depreciation. Unlike individuals, companies do not benefit from allowances for holding period. The entire capital gain is included in the company's taxable profit and is subject to corporate tax at a 15 or 25% rate. Corporate tax companies' concrete calculation of the capital gains and related taxation. For a corporate tax company, the gross capital gain on real estate is calculated as follows: sale price minus purchase price plus depreciation. Let's imagine a city company that purchased a building for 500k and depreciated it over 10 years at 50k per year. After 10 years of time, the net book value of the property is zero, 500k minus 500k. If the company sells its property for, let's say, 700k, the gross capital gain would be then 700k. Sale price minus zero, which is the net book value, remember. Good to know. It's also possible to deduct any previous carry-forward losses from taxable profit where applicable. This capital gain of 700,000 euros is then subject to corporate tax at the applicable rate. With the reduced rate of 15% followed by the regular rate of 25%, this would make a total tax liability of 169,000 euros. Unfortunately, that's not the end of it. Since a corporate tax company is a legal entity separate from the shareholders, the proceeds from the sale of the property belong to the company unless dividends are paid to the shareholders. As a non-resident, you would be required to pay a French withholding tax of 12.8%, which can then be deducted in your home country against the final tax payable on this dividend, provided there is a bilateral tax treaty, of course. Do not forget to dissolve and liquidate your company once the property is sold and the funds went back to your country if you no longer need it. As long as the company exists, the tax authorities will continue to expect tax returns. Corporate tax company. Is this a good real estate investment tool or not? The decision to invest in real estate through a CT company rather than as an individual depends on different factors, including investment strategy, holding period, and capital gain prospects. Advantages first. Tax optimization. Depreciation allows for reducing taxable profit each year, which is especially advantageous if rental income is high. Moreover, if the profits are not distributed as dividend, corporate tax remains the only tax payable. Reinvestment. Post-tax profit can be reinvested in acquiring new properties, thus increasing the company's asset without immediately increasing shareholders' tax burden. Flexibility. The company structure allows for more professional management of the real estate with the possibility of including external investors or rising funds. Disadvantages now. Tax on capital gains. As you understood, the absence of allowances for holding period can result in heavy taxation on capital gains, especially in the case of a sale after a long period of time. Administrative complexity. The accounting and tax management of a CT company is more complex and expensive than that of an individual and requires annual accounts maintained by a professional. Dividend distribution. In the event of profit distribution, shareholders are subject to dividend tax, leading to two different taxation. First, at the company level, and then at the personal level. Benefit in kind consideration. Since a company under corporate tax is commercial by nature, the tax authorities expect the property owned to be rented all year round, requiring you to include the benefit in kind for its use in the annual account. Depending on the type of property, this can quickly add up. For non-resident, investing through a CT company can offer an interesting solution, especially for estate protection and succession planning. However, the administrative complexity and various tax implications make it an option to be handled with care, best suited for experienced and well-informed investors. If you have any questions about this topic, whether concerning an existing company or a real estate acquisition project, do not hesitate to contact us. This is our specialty at French Tax Online, and we would be delighted to guide you toward the most suitable option for your case. I wish you all a great day and see you soon for another exciting video.